name is Andy Wilms. I'm President and CEO of the Milwaukee Company. And joining me this morning is Mike Wilms, who is the Milwaukee Company's Chief Operating Officer and our Compliance Officer. A quick reminder that nothing in this podcast should be construed as investment advice, and the views expressed by Mike and me are our personal views and not necessarily those of the Milwaukee Company. And with that, I'll say good morning to you, Mike.
Good morning, Andy. Good morning, everyone.
I hope your day is off to a good start. We sure have had a beautiful summer this summer. I mean, the weather has been here in Wisconsin has been idyllic, and today has been it looks to be another one of those idyllic type days. So,
and actually, I should ask you: can you hear the road traffic behind me? I've got my window open because it's so nice out.
No, I don't hear anything. So very good.
Then I won't worry about closing it.
No, I don't think you need to. Well, let's get started with the market recap like we usually do. And last week was a milestone week for the U.S. stock market as the Dow Jones finally joined the S&P 500 and the NASDAQ by entering into positive territory for the year. But as we've been talking about for weeks now, the chasm between the winners and losers remains extremely wide. At the end of the week, U.S. large caps were up by about 9.6% year to date, but the U.S. small caps still remain below water with a negative 4.5%, which sort of brings into question the whole small cap value premium that people have talked about for decades. Not to miss out on the fun, emerging markets also reached a milestone last week as they turned positive for the year. They had a 2.7% jump last week. Really, the only loser had been the big winners, which was the U.S. investment grade bonds. If you look at that sector as measured by Vanguard's total U.S. bond market, symbol is BND, of course, that sector lost 60 basis points last week. And by the time the market closed on Friday, it was at a 2-week low. So momentum seems to be slowing, at least in that sector. This week, stocks were missed on Monday as the Dows dipped a little bit, and as well as the S&P, while the NASDAQ was notched a 70 basis point gain. The Dow and the S&P were hurt by bank stocks, whereas NASDAQ and Apple got a lift after their stock splits took effect on Monday. And then, well, let's talk a little bit about those stock splits. A little off script here, and just ask you what you think about all this, how these stock splits are pushing up prices.
Well, it's an irrational kind of market response. The logic to the split is to have a lower price stock that's more accessible for the average investor. It's easier to buy something at $20 a share versus $400 a share. But if you increase the number of authorized shares and then split the stock, if you start out with a stock that has a book value of $50 a share and you split it 2 for 1, you still end up with $50 worth of book value, which is 2 shares times $25, and book value being the difference between the company's assets less its liabilities.
Right. I mean, there's no financial sense to stocks going up simply because they split. And what I find sort of surprising by it is that in the past it made sort of sense, right? Because by splitting the stock, you put it in, in reach of the more average investor. But now you can buy fractional shares of a stock, so there's no reason to split it. You can buy, so you get to the exact same place buying a fractional share of a more expensive stock as you do buying an entire share of a less expensive stock. And there was a significant maybe unanticipated, consequence of this was the makeup of the Dow, which I think we talked a little bit about yesterday, had to change dramatically because that's a price weighted index. So when you had these stocks split, Apple split, and its price went down, that means it played a much smaller share of the index, which meant they wanted to get other tech names in there to keep the relative weighting of tech about the same. So
Correct.
you ended up throwing out some names and adding some new names, and that really has a major impact on the composition of the index in my mind. So,
I couldn't agree more. I mean, everybody knows of ExxonMobil,
all right.
um, and it was replaced by, take your pick, Salesforce or one of the other new additions.
ExxonMobil, I think, and its predecessor, Mobil, and other predecessors had been in the index for over 100 years, and it's like, see you when I want to be it.
Well,
Sometimes.
and one of the most respected investors of all time is Warren Buffett, and he had refused to split Berkshire Hathaway shares because it made no financial sense.
Right,
So,
right.
I mean that's a pretty good benchmark to reference when you're thinking about whether it's a reason to be buying one of the stocks that's splitting or not.
Well, I think it's being driven, by millennial investors who, a lot of these people playing around in Robinhood, and I hear about this because my kids are millennials and their, friends hang out and they all want to talk about stocks and things like that every once in a while. And, they really don't know. They're playing around with Robinhood and they don't know really what the heck they're doing. And I love these kids, they've been my son's friends and my friends since they were in grade school. But, man,
Now let's start thinking about history here. I mean, if you go back to the '29 crash, everybody was getting their stock tips from the shoeshine guy.
yeah.
And if you go back to the .com crash, you were getting your stock tips from your cab driver.
Well, I would suggest to you that the shoeshine guy didn't know Shinola about stocks either. And I'm afraid that some of these young guys are playing around in stocks, but I don't know anything about what they're doing, and that's really why this stock split is making such an impact. Not to be critical of millennials, I think it's fantastic that they're getting so involved. I wish they were getting a little better advice along the way. That being said, let's talk
Moving right along.
Well, what's that?
Moving right along.
Moving right along, I should probably wrap up what happened yesterday. And yesterday was a good day for the markets. All the indexes had solid gains, and they were building on Wall Street's best August performance for three decades. So the rally continues, notwithstanding the situation with the COVID pandemic, which I'm hoping you'll update us on.
Well, the total number of cases in the United States has now exceeded 6 million, 25 million globally, and there's positive and negatives in the numbers. Thailand, a country of almost 70 million people, has not had a recorded new infection in 100 straight days.
Wow. I know that.
And on the flip side of that, just across the Indian Ocean, Australia recorded their first recession in 30 years based on lockdowns and effects of the virus. So, I mean, it's really essential. There's centralized pockets of virus outbreaks, and we have been testing here at a elevated level again, where the number of tests per day had dropped to 600,000. It's now back up over 700,000. The 7-day average number of new infections most recently had broken below 40,000, just barely, but below 40,000. It had been at a peak of almost 80, and we logged the lowest daily death rate here recently of just 305 people.
Yeah, that was terrific. And I mean, not terrific, but it's 2 steps forward, 1 step back kind of thing, I guess.
An infinitely better result.
Right. Thank you. And we've got these vaccines. I think there's like 35 of them or something like that now in clinical trials. And it seems like we could be looking at a vaccine, available at least in limited numbers by the beginning of next year. And I just heard on the drive in today, on my way into the office this morning, that the Trump administration was releasing several million of these very, very quick tests that we heard about, that give you the results in a very short time frame, couple hours or whatever it is. To the states, and let each governor decide how best to make use of them. So, but then again, on the other side of the coin, step back, you got the governor of Iowa ordering all the bars and taverns and wineries and breweries and whatnot and nightclubs to close in 6 counties there, because the virus is spreading rapidly in Iowa.
Well, and that's
at least in those counties, I should say.
That's a kind of shift here in hotspots where Iowa and South Dakota had very, very low infection rates, and now they're moving to recognition that they're more of a hotspot.
Yeah,
and
exactly.
It's kind of, there's no dictating personal behaviors, because Iowa State announced that their September 12th football game, 25,000 of the season ticket holders can actually watch the game in person at the stadium.
Wow.
And Eames is the second highest infection rate right now, based on city size, in the country. So, I think that kind of covers where we are at this point. They're moving forward with researching not only just the vaccines, but therapies, and we just have to be hopeful that it'll be sooner than later.
Okay, great. Well, that's for sure. I think we're all hoping for that. Let's, from the economic highlights, it was an interesting week. Unemployment remained frustratingly high, for the week ending August 22nd. Initial claims for state unemployment benefits topped 1 million, which was a slight decrease from the previous week, but still way, way too high. And the 4-week moving average also dipped a little bit, but again remained above the 1 million mark, which is, it's just extraordinary. But the big news probably was what Chairman Powell announced when he announced the major policy shift, which we talked about last week in anticipation of the announcement. No surprise there, he said that the Fed would be adopting flexible average inflation targeting, which would allow the Fed to inflation to rise above the 2% rate. For some, currently targeted 2% rate for some time, following periods when inflation has been persistently below that 2% target. The truth of the matter is they don't have a target now. There's no constraints on how high they can really let inflation go, because we've been below 2% for almost a decade now, I think. And so, really the Fed's got carte blanche on how high they let inflation go, which is what they want. They feel they need, I should say, because they don't want to be in a position where a rise in the inflation rate forces them to turn off the spigot when they feel money still needs to be poured into the system. So we'll see about that. I still, call me old-fashioned, but I'm still worried, very much so about the growth of the deficit and what it's going to take to service that debt, maybe not tomorrow, but down the road if interest rates come higher. And I think it could potentially down the road be a very serious problem for our country. And a lot of people disagree with me, a lot of very smart people disagree with me, and I certainly hope that they are right. But it is something that I do keep in mind as I chart a course for the future for myself and my clients.
Well, as much as I like to take exception to what you say and think, I agree with you 100%.
Good. Well, it was fun. I just for fun, I thought we'd change our roundtable discussion around a little bit somewhere where we can at least for the sake of covering both sides of the argument, disagree. Although we're not going to really be expressing our personal views. I want to make that clear. It's really what we want to share, both sides of the argument. But I thought there's been no shortage of disagreement on the market commentators of what's happened in the markets and the economy, even though you and I are pretty much of the same mind on much of this. A lot of the people who are commenting on this are on completely the other ends of the spectrum. So I thought it might be fun to kind of share with our audience both the bull case and bear case on where things might be headed on a number of issues. So I'm hoping you'll play along here this morning. And the first one, of course, probably most appropriate for this podcast is, will the stock market rally continue? And I'm going to ask you take the bull case, whether you believe it will or not. Why don't you argue? What would be the bull case for the market still, the rally continuing?
Well, first of all, I mean, top of the list, everybody acknowledges, however you look at the equity markets, it's forward looking. And part of the logic is that earnings will be improving, and that's going to lead to higher stock prices. I look at it at I go back to your comments about Chairman Powell and how accommodative the stance is that the Fed has adopted, and the old cliche about "don't fight the Fed" is probably the biggest factor in what's happening in the equity markets right now. I was really kind of surprised. I saw an article yesterday on Bloomberg that the Federal Reserve has purchased $1 trillion worth of mortgage-backed securities in 2020. That's far in excess of anything that I had seen previously. I knew that there was a big chunk that was purchased in March, but they've purchased $300 billion in March, $300 billion in April, and they've been purchasing about $100 billion versus the 40 that had been announced. And all of that cash is pumped into the banking system, and it's rotating into other risk assets. And I think equities is a big part of it.
Well, it's no doubt the Fed said they have no limit as to what they're going to do to stimulate the economy and keep it from falling into a major recession because of the outbreak. So you make a very good point, but just to pay counterpoint the bear case, I would suggest to you that history has shown that when you've had these tremendous winning streaks, near-term stock returns tend to moderate, right? They don't continue to grow at these rapid paces. Where you reach the top, nobody knows, but sure, if history was your guide, you'd say we're getting very close to that if we haven't hit it already, and so it might be time to take some risk off the table. And we're still dealing with the fact that while considerable progress has been made on treating the COVID-19, we got to remember that this is not a stagnant virus that mutates, and
yes,
it's quite possible that it could mutate into either something more dangerous, more deadly, or that the treatments being developed to treat its current form won't be effective against something that it mutates into, and we could be back to square one with it at no time. And then we have to keep also the election that's pending. It's quite possible that after the elections are passed, that the party that is in power could adopt policies that are far less favorable to the stock market and to investors. So you put those three together, and I think there's also a strong argument could be made that the bull market is, if it hasn't run its course, it's getting close to that standpoint. So maybe fighting the Fed might not be such a bad idea. Who knows? We'll find out.
Well, and I think that all three of the points are well taken. But the election results could have the most major impact here, depending on if the Democrats are in control of the House and Senate. With Biden as president, I think the betting public would be looking for a tax increase.
Right. Now, people have always tend to over-exaggerate, what the impact elections will have on the stock market. But I think in this time around, it is particularly important. Okay, so now let's go to another question, Mike. Okay, is the coronavirus recession over? And why don't you take the bull case on that one?
Okay, well, I mean, the definition of a recession is a GDP decline 2 quarters consecutively, with the massive drop in the second quarter, and the expectations for GDP growth in the third quarter of 2020, and continuing growth. From a data point basis, I would say that the recession is over. I also would revert back to don't fight the Fed, because all of the recessions going back to the 70s have required the Fed to be raising interest rates to slow economic growth. And even going back to the most recent recession here, the financial crisis, the Fed was raising rates up until June of I think it was June of 2006. They raised, and it's kind of a scary number here. People can't remember that Fed funds in June of 2006 were raised to 5.25%. And 9 months later, we had an inverted yield curve, and shortly after that, we were in the last recession. So, I think it's going to be there's positive economic data, as you had pointed out, that's been coming out on a regular basis. Everything from retail sales, car sales, manufacturing. The numbers have looked pretty good here. They've been a little bit of a up and down kind of thing, but trending in the right direction.
Yeah,
and the Fed is accommodative.
If we look at this from the other point of view, just to again play devil's advocate, I agree with you that the definition technically has been met probably in this third quarter, but definitions that predate the coronavirus may not be applicable any longer, for this particular situation. I mean, yes, the economy is still recovering, to be sure, but it's slowing already. The economic growth slowed in July, and it looks like it probably, the rate of growth slowed in August as well. And then you got this fresh layoffs and furloughs, and you've got unemployment. It's still incredibly high. I mean, it's hard for me to say that you're not in a recession with the unemployment numbers we just talked about, and the Democrats and Republicans remain in deadlock over the next stimulus bill. Who knows where that's going to end up? And while you don't want to fight the Fed, I don't think the Fed can do everything. Isn't all the almighty, where it can just unilaterally prevent a recession during a situation such as this. And in reality is, I don't know if that's something they should do, because trying to go to any extreme measure to prevent some pain now could result in much, much greater pain down the road for people in the future. So, I'm not at all sure that the recession, has really come to an end. It really depends on what's going to happen with the virus. But what about inflation? Okay, so if we're talking about the recession having been an ending, might that bring additional inflation pressure? And we heard what the Fed did, to allow inflation to drift higher. Let's talk about whether inflation will be returning. Why don't you, in this time, take the case against inflation? Argue that maybe we won't be looking at inflation. What would be your, if you believe that point of view, what would you be asserting?
Well, I mean, the case against rising prices is lack of demand for the issues that you just cited around employment levels, the high level of unemployment, some of the furloughs becoming permanent layoffs, The demand side of the economy here for the first 3 months of the pandemic was largely driven by the government fiscal stimulus, not the Federal Reserve.
Right.
So the $1,200 payments, the additional federal unemployment, and right now those programs are complete. And to your point, also, they're arguing about the additional support that is going to come from Washington. In the most recent bill that was proposed yesterday in the Senate was only $500 billion, which is 50% of what they've been talking about previous to that proposal.
Yeah. Well, you're right. But then again, we look at the fact that, the governments worldwide have pumped an estimated $20 trillion into their economies to keep another great recession at bay. 20 trillion. And I agree with you that the velocity of money really is what determines inflation more than the quantity. And, when we talk about velocity of money, we're talking about the frequency at which it changes hands when goods and services are being bought and sold. And that hasn't really risen much because a lot of this money that is being pumped into the economy, as you've already pointed out, is ending up in the stock market, is ending up in bank accounts, is ending up in real estate, and not ending up in the purchase of goods and services. But that's sort of a temporary, I think that may be a temporary phenomenon. People aren't going to be spending a lot of, going to be more inclined to save when they think you're in a recession and they worried about their job. But that money will become, you would think eventually that money will be entered into circulation. And the more money you have in circulation, of course, the less value, more dollars in circulation, less valuable each dollar becomes. So when a dollar becomes less valuable, it takes more dollars to buy something than it did previously, which is the definition of inflation. So bottom line, I don't see inflation maybe as an immediate concern, but I still believe that as the money supply grows, if money supply grows faster than economic output, ultimately expected inflation is the expected results, all else being equal. So. But, again, this is one of those things where people could take either point of view. We're getting a little low on time, so we'll take this last one quickly, but I think it's something that you'll have an opinion on, and that is the worst of the pandemic behind us. You could take either view here. I'll let you pick. Do you think it is or isn't?
Well, I'll defer to you taking whichever side you'd like here. You want to start with the bull case, and I'll take the bear case.
Sure. Well, the bull case is pretty straightforward. You have the vaccine development that has occurred at a record pace. You've seen death rates fall as treatments have improved, and you could argue that people, are taking simple precautions like hand washing and social distancing more seriously. So you put those three together, and you could say to yourself, yeah, the worst is behind us with regard to the pandemic. We're heading in the right direction.
Well, and then from the bear case, and if you look at the actual clinical data for treatments like the remdesivir, they're debating whether it's actually 35% effective. A vaccine that right now the FDA is looking at emergency use authorization for a vaccine that's just 50% effective. And you're going to have 50% of the population that won't take a vaccine based on just their own personal views on vaccines.
That's a big problem.
So I mean, and you've got the compounding effect there.
Yeah, it's hard to get herd immunity when have a very large percentage of the population that won't even take it, and you got the issue of being able, once you have an effective vaccine, and I think we're going to be, I tend to believe we will have a very effective vaccine, in the 70% or higher by the end of the year, given that we got like 35 of them, as I said, under analysis. But if you ain't anyone to take it, if you don't get enough people to take it, that's a problem. And you still have to be able to produce billions and billions of doses to cover the world. So yeah, there's definitely a bear case to be made as well. But given that,
certain viruses, the development of vaccine has been extremely problematic, and top of the list would be HIV.
Yeah, that's true. But let's not get up for curmudgeons. And then on such a negative note, let's take the more positive thing. And per point of view in that on this, and I think it's really going to boil down to, in my mind, more than anything, people taking the precautions more seriously. And you're going to have parts of the country or groups of people that simply won't. But I think that number may be going down more and more every day. And even some of the naysayers now have gotten more serious about it, and let's hope that continues.
Well, I think a great indication of that is of the behavior of everyone in Hong Kong, where if you go back to SARS, everyone wore their masks, and it became a social norm, and you're kind of a pariah if you're not wearing a mask. So. People's behavior can be changed to be extremely helpful in a situation like this.
But certainly hope so. Well, on that happy note, then, I think we'll wrap it up for today. I want to thank everybody here for joining us. We're very glad to have you. Please keep in mind that you should not act on anything you've heard in this podcast until you discuss it with a professional who's familiar with your personal situation and investment objectives. And I just want to make a side note that we will not, for those of you who have subscribed to our weekly newsletter, there will not be a newsletter this week because of the holiday, and my suspicion that very few people will read it if I do it now. And hardly can blame you, since this is probably the last weekend of summer. But if you aren't a current subscriber to our newsletter, I'd encourage you to hop on over to our website, themilwaukeecompany.com, and click under the media tab, and then click on the newsletter tab and subscribe. Hopefully, we try and keep them short and sweet, but hopefully you'll find content there that will be of interest to you every week. And with that, I'll say have a great holiday weekend, everyone, a little bit early. And Mike, we'll talk to you again soon.
Take care. Bye-bye.
Bye now.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.